Hi, Jamie. Coffee
Hi,
talk with
Sam.
Jamie with no coffee.
Yes, I love that. No coffee.
So let's talk taxes. Talking from a perspective of a business owner, we know that, well, first of all, I know your taxes are probably pretty complicated. Mine's can be complicated as well. And every business owner just hates this time because of how complicated it is. But other than the number one focus is let's pay as little as possible to the IRS. That is obviously legal, which is fair. That's one of the perks of being a business owner. But that could bite us in the end.
Well, if you're thinking about selling, one of the big things is the SBA, Small Business Association, is going to go back and look 2 to 3 years back, maybe further. So if you are possibly going to sell even in the next 2 or 3 years going forward, you want to make sure that you're filing your taxes in a way that we can justify everything that has been written off and add it back as a seller's discretionary earning. But we can only do so much of that. So, while we can certainly add back things that are seller discretionary, are things that they're able to, automobiles and things like that the IRS says legally are write-offs, but a new owner going forward may not have to use. The challenge, though, is that, for example, a lot of business owners will say that they contributed to their business, so that they basically added money back into the business. It's a tax deferral strategy. Great strategy, totally legal.
Sure.
But the amount that you use for that, that's hard to justify. That's going to hit your net profit, and that really is then times the multiple in terms of how much sales price you're going to get. So it's thinking through how you file your taxes and, beginning to have a conversation with your accountant about, hey, I might be selling in the next 2 to 3 years. What can I do to make sure that I'm taking advantage of tax strategies that are out there, but also making sure I'm preserving the value of my asset so I can get the best sales price.
No, and I know we go through this with clients all the time, but we want to look as poor as we can to the
Right.
IRS on
Yes.
purpose. At
Yeah.
the same time, like you just mentioned, if we take too many of these strategies and we are at a net negative, we can't add back income that potentially we know is sort of there, but a buyer is going to look at that and raise his eyebrows if we're asking some ridiculous multiple of nothing.
Right. Another concern is, depending on the type of business, if you are using some of the materials and labor of your or cogs of your business for your own personal use, totally fine, totally within the law of the IRS. But in terms of a sale, it's really difficult to tease out, well, there wasn't an invoice to go against these, and so we need to reduce that number to truly show what the business is making. So, the net bottom line is you want your taxes to reflect as closely as possible to what's happening, particularly income coming in. Probably the most important piece is that your income matches correctly on your tax return. What you do in terms of deductions and things like that, we can often, work that out. Again, the SBA, if somebody's buying using SBA financing, they have limits that are their standard. So, a buyer may not be able to get a loan if you've written off too much or gotten too loose with that. But there's the bigger point would be, if you're in an industry where you are not necessarily passing all of your income through a bank, and you may or may not be reporting all that income, we can't then show that income on your profit and loss statement and justify it as part of a sales price.
Yeah. So seller's discretionary is not completely discretionary.
Yeah.
So yeah.
And then
And that
it's not seller's discretionary income, it's seller's
exactly.
discretionary earnings. Yeah.
Earnings. Exactly. Big difference. And so especially in cash businesses, a lot of cash business, whether it's vending,
Right.
whether it's either contracting or whatnot, hate to say it, but it has to pass through. It has to pass through the financials. And that's one of the issues that we see a lot, is that companies that we know are profitable, that are actually doing well, that people have been taking care of their families for years, don't show exactly what's happening. And then we can't justify that to a seller. And I just want to kind of harp on that point, because since we're not everything is based on the multiple of earnings, but most of the value is based on those multiple of earnings. So for every $10,000 of earnings that's not shown, and let's say you have a 3 times multiple, that's $30,000 less, or $300,000 less if you're showing $100,000. I mean, it very much is a multiple. So we got to show that.
Absolutely. That's one of the biggest dilemmas, I think, for business owners in filing their taxes, is that point. Another one is that a lot of times you've been doing those strategies for years, you know, a deferral, kicking the can, if you will, and that can does come up when you sell. So there are just strategies you've been using to protect liquid assets at the time that are, when you sell, then kind of hit a fan, and you can't do that strategy going forward. So it's a good to have that in mind from the beginning, because as you're going through the years, if you're continuously deferring, you're through different tax strategies. You're either going to take that hit in the sales price, or you're going to take it in. You can no longer take that deferral, and so now there's going to be a bigger amount due, which will reduce your then earnings from a sale.
Yeah, because that has to be paid.
Yeah.
So cool. So I mean, really, the takeaway is like, okay, nobody loves the taxes, nobody loves to pay taxes, but if you're really looking at selling soon, talk to your CPA and make sure that you are showing what you should be showing, even if you do have to pay a little bit more taxes. And really, it needs to be at least 2 years, right? I mean, that's what we've been seeing.
Minimum. It's a
Minimum.
minimum 2 years.
Better to show more consistency than 2 years.
Yeah. Minimum 2 years. And also, you know, many of us will take a deferral to September on extension. And if you're going to be selling, if you're listed currently and or you're going to be listing, you need to not do that. So because we need tax return. Even those who listed in October, November, December, you know, filing on the sooner side really helps with making sure that we can process your returns, and the SBA can do what they need to do if it's not a cash buyer.
Yeah, absolutely. And just to wrap it up, that, you know, we talk, well, in the Value Builder system that we do use for people, there's 8 key drivers. One of those drivers is exactly this, is financial management. It really is cleaning up your books and showing exactly what the business is. And it is absolutely worth it to pay a little bit of taxes to show what you have in seller discretionary so that you can get that proper multiple. So, hey, get your taxes done.
And we're also happy to look at the taxes. Like, I'm happy to always look at a draft before you file. You know, usually your accountant sends you back a draft, and we can just give you a pass of like, this is what we think the SBA will see. This is what we would, as people who work with buyers, this is how they're going to interpret that, so that you can make choices about, maybe I, you know, wrote off a bit too much, or maybe I should write off more. I mean, sometimes there's that too, or maybe you're just perfect. That's always an advantage if you're comfortable, you know, sharing with if you're using a broker, sharing that ahead of time so they can give you feedback, because filing an amendment, it, you know, obviously delays the process.
Yeah, no, for sure. Love taxes. Awesome. Cool. Well, hey,
another tax season.
File your taxes, get her done, sell your business.
Yes,
Live well.
all the things.